Started. Okay, so we have been learning a lot about futures, forwards, swaps. These are the what I call the zero-sum instruments. But then now let's move on to a new class of assets, a new class of derivatives. They are the futures that we will be learning about. So there are quite a few distinctions between futures and all those set of classes of assets, and also from options. So first, like previously, like you see when during the midterm exams, we have been calculating some futures price or forward prices. These prices are something like what we call the strike price. And you can see that for options, there's actually an additional flavor that we have to consider about. In options, there is also an exercise price or strike price. It's an element that we will be using the capital K for notations. But on top of that, we still have a price for option themselves. This is the value of this right. Like we all know, options are rights. They are rights to do some kind of well-defined actions. It could be buying the underlying assets or not buying the underlying assets, or it could be selling or not selling underlying assets. It is a right, which means that you can decide not to do so. And these kind of rights are, of course, like comes with some values. So the rights themselves can be priced. So on top of those strike prices, those Ks, later on you can see that for future, so for options, either call option, put option, European or American, or any other exotic options, we will be able to do pricings and understand what is the price of these assets. We'll begin from the most basic part. In this chapter, it's basically just introducing you guys to some properties about options. And basically, of course, we are only going to introduce you guys the most naive, straightforward, or people call plain vanilla options, the European put and calls. Later on, we'll also talk about what are the strategies you can build on these options, and also we'll also talk about American options. In the future chapters, we'll be talking about how we understand the profit and loss and also the payoffs. You will also learn about some of the special methods to do pricings for these options. We'll be describing about one very specific type of pricing methods. It's called the binomial trees. Basically, you do backward inductions to think about what is the possible ending knots of all kind of consequences, and we just construct some risk-free payoffs and then discount those risk-free payoffs using risk-free rates back to present to obtain what is the correct value of the options. You'll have a better idea when we move to that step. We'll be talking about binomial trees in chapter 13. In chapter 14 and 15, we'll be talking about the celebrated Black-Scholes formulas. We'll be very briefly discussing about what is Ito's lemma and some very brief, very simple version of stochastic calculus, and then we'll talk about how we can connect the binomial trees and also the Black-Scholes formulas. Afterwards, I think we still have a few more weeks. I'll probably talk about volatility smile. I'll talk about what is implied volatility, what is VIX. Also, if we still have time, maybe we'll talk about the Greek letters, where we can characterize different moments of these option prices. To begin, chapter 10 is the most obvious and most straightforward chapters. A quick review once again, even though we talk about it in chapter 1. What is an option? What is a call option? What is a put option? A call option is an option to buy some underlying assets. A put option is an option to sell some underlying assets. And the most popular two types of options are the European options and American options. European options are options that can only be exercised at the end of maturity, by the time when this right expires. And for American options, it can be exercised at any time you like, at any time the holders feel it finds it appealing to do during the whole maturity, throughout the whole life of this assets, this derivatives. for, like we mentioned, for any kind of financial assets, you can long, you can short. So for long and short, and also for put and call, we can have 4 type of combinations. You can longer call, longer put, shorter call, shorter put. It's very different. So let me just very quickly talk about what all these 4 types of positions means. And also later on, we'll be talking about something very important, but probably your most plans. There are actually 2 types of different graphs that I'll be showing you throughout the whole the second half of the course. The first one is what we call the P&L, the profit and loss. For profit and loss, basically what we mean is that we'll draw the payoff diagram and then we'll do a vertical shifts of these diagrams according to the cost you paid or the cost you obtained to construct these positions. That's the reason why it's called P&L, profit and loss. The second type of diagram we'll be showing you is basically the payoff diagrams. Yeah, let me just draw the 2 and you guys will see the difference. Okay, so this one, what you see over here is the P&L. And let's draw the corresponding payoff diagram for you. So what do I mean by payoff diagrams? Payoff means that what you're going to expect to get or lose by the end of some kind of like maturities. In this case, we're talking about buying 1 European call options. The option price is $5. The strike price is $100. And so for any kind of figures, whenever you get the figures, make sure what is the axis on the vertical axis and also on the horizontal axis. Here, the horizontal axis is the stock price at the maturity. It says that at maturity, the stock price can have a range as low as more than 70s or as high as more than $130 per share. And you can see that when we draw a payoff diagram or when we draw a profit and loss diagrams for a European call, there will be a long European call. There will be a kink at exactly the place where the stock price was exactly the same as the exercise price, the strike price. If we draw a diagram, if we draw a payoff diagram, payoff of a European call, the payoff diagram looks like this. 45-degree line. This is the payoff diagram of the European call, a long European call. You can see that what is the difference between these 2 diagrams? It's just that for the P&L diagram, we shift the whole figures downwards for the $5 intervals. Why was that the case? It's basically because it's mentioned that the option price is $5. You might think it sounds so straightforward and so stupid, but then after all, I think you'll see what the real power behind comparing these 2 diagrams is in, I think, chapter 11 or chapter 12. It is because when we are there to do pricings, like I mentioned at the very beginning of the semester, at the beginning of chapter 1, I think I mentioned that when we do pricings of especially like derivatives, the way we do is we try to construct the same payoff schemes. We try to build this exactly same payoffs using some combinations of other financial assets. By doing so, if we can replicate the payoff, then you can see that that kind of the cost of the replication must be exactly the value or the price of this derivative. So say this is an option. So it means that if we can compare the profit and loss diagram and also the payoff diagrams, say if we try to mimic this payoff and we build it using some bounds and also the underlying stocks themselves, and we see that there's a difference of a $5 difference between the payoff diagram and also the P&L diagrams. It basically implies that the call option over here should come of a price of $5. You'll see what I mean afterwards. So you'll probably don't have a better feeling at this moment. Never mind. just keep this in your mind. Make sure to check whether or not we're drawing a P&L, a profit and loss diagram, or a payoff diagrams. Okay. So now let me just elaborate more about these diagrams. Why do we have a kink over there? It's because when we talk about European calls, again, call option is an option. You can decide to exercise it or not. And if you decide to exercise it, it must be the key find it profitable to do so. So let's take a look at the payoff diagram once again. The strike price is $100. It means that it guarantees you that you can buy this stock at the price of exactly $100. If it turns out that at the end of the maturity, the stock price is lower than $100, then it's not profitable to do so, to exercise the right. You should just leave it and forget about it. So that's the reason why in the payoff diagram, when the stock price is below $100, you should not exercise this European call. On the other hand, when the stock turns out to have a price that's higher than $100, for each dollar higher than $100, you're going to earn exactly the same profits if you are going to buy this one stock. Say, if the stock turns out to be $105, each stock purchased through this call options, you're going to earn a $5 gain. That's the reason why we have a payoff of $5 over here. It's because you're going to buy something that's worth $105 using the cost of $100. Let's use another numbers. We have too many $5 over here. Let's say it's 107. Okay? That means that every $1 higher than the strike price, you're going to earn that additional numbers of the price. And then basically what we do by going from payoff diagrams to a P&L diagram, it's just we just downshift it if we are going to pay something to obtain this payoff. And here you can see once again, let me just reiterate it once again. It costs you $5 to buy this call options. That's the reason why the P&L diagram vertically go down by a size of $5. That's a long call option. Anyone has any questions so far? No questions. Good. What about put options? Put options is like a mirror image in the horizontal axis. We're just shifting things horizontally from the long call options to the long put options. What do we do? So now when we have a long position in the put options, it means that you have the right to sell something at a predetermined, a pre-specified price. Here, it means that we agreed to sell this underlying stock at the price of $70. That's the reason why you can see that when it turns out that the stock price sell at this predetermined price. On the other hand, if the price of the stock turns out to be very high, then there's no use to sell the stock through this put options. You can just sell the underlying right away at the stock market if the stock turns out to be of a price of $90. But then if it falls to a price of $40, then it's really rewarding to do so. Once again, we have a downward shift from the payoff diagram to the P&L diagram. Why was that the case? Because this kind of right must come off of some price. The put option has a price, and in this case, in this example, it is said that the put option has a price of $7. Okay. Now let's move on to a short call. What is a short call? So now, if you are taking a short position in a call option, it's seemingly as if you are underwriting these call options. You're standing at the side where you promise someone to sell the underlying stock to your opponents. Your opponents now possess the right to buy at any time he or she finds it profitable to do so. And you are now standing at this position where you may have an endless loss. You can see that the short call now is like a mirror image, but in the vertical sense, comparing to a long call. The long call and the short call is like a mirror image in the vertical sense. if we draw the payoff line once again, let me use another color. If we are to draw the payoff diagram of a short call, it is flat line over here and then another 45-degree line that goes down. But then now you can see that underwriting this short call position gives you some kind of premium because you can see that there is an endless possible loss when the stock goes to a really large price, really high of a price. That's the reason why when you're underwriting this kind of positions, you obtain some flows upfront because it seems like as if you are selling these call options. That's what we mean by short call positions. There's an upward shift of a $5 amount. Why was that the case? It's because you are selling this right to your opponent at a cost of $5 per share. That's what it means by the short position in the call options. Once again, let's take a look at these diagrams carefully. If there's nothing happen, if the stock price turns out to be lower than $100, then your opponent will not find it optimal to buy the stock through exercising these call options. That's the reason why there's nothing going to do. There's no payoff. That there's nothing going to happen if the stock price turns out to be overcome with a price lower than $100. And if we take a look at the P&L diagram, this is the kind of situation where you actually earn this $5. You don't have to worry about anything. You just earn this $5 and your opponent are not doing anything that will harm your profits. On the other hand, say, once again, if it turns out that the stock price comes with a price of $107, then your opponent who has a long call position will find it optimal to do so. He or she will buy the stock at the price of $100 from you, while the stock has a true worth of $107. It means that you have a loss of $7. In these scenarios, you lost $7, but then you earned $5 upfront. So the P&L over here is a -2. Everything okay? Okay, so that's a short call. And a short put is also very straightforward. It's just like a put options, but then now we are talking about a short positions. You are promising someone that he or she can sell a product to you at any time he or she, not any time, sorry, at maturity when he or she finds it optimal to do so. So you can see that once again, if we compare long call, long put, and short call, short put, you can see that there are some interesting features. First, when we have a long position in either call or put options, we have a secured downside risk. The downside risk is just basically not exercising these rights. But then on the other hand, we have a very optimal, unlimited upside potentials. If the stock price goes really high, the long position will give you a really large of rewards. If you have a long put and if the stock price drops to a really low level, then you also enjoy a very high gains. And another reason why some people will try to persuade retail traders like you and me to buy or sell to trade on options is because it's basically like trading on a very leveraged positions. Now you're going to earn this addition for each dollar. You're also going to enjoy this the same amount of gains. But on the other hand, you are not buying this stock at $100, but you are just owning this. In this example, you are owning this right at as small as the $5 payments for the option prices. So it's seemingly like you are leveraging very heavily. Then it's obvious that, yeah, you can make 20 times of a fortune comparing to buying the stock and wait for it to grow. But yeah, everything is symmetric. If you are going to have this high potential gain, you are also going to have a very high potential loss. What is the potential loss over here to stand at a long position? It's basically the payment that you pay for this rights. If it turns out that it's not optimal to exercise it, then your payments are just like a dead weight lost. You just give it away and you do not own anything afterwards. This is also the case for the short positions. It's the opposite for the short positions. For short positions, you are just betting that things will not go in the same direction as your opponents are guessing. You hope that you earn the premiums and nothing happens. That is the side of the short, that is the mind of the short sides. And you can see there's unlimited downside potentials for short positions, either call and put. But then the upside potential is truncated. It's basically just your premiums you earned at upfront. So now again, it's usually like when we are there to learn about option pricings, we usually begin by looking at the payoff diagrams. Like this one, we don't care about those costs at first. We begin by looking at the payoffs. Once again, it's because we try to, if we can replicate these payoffs, then we can basically price these underlying assets. So we always begin with the payoff diagrams. Now let's talk about what is the payoff of these four positions. We have a long call, long put, short call, short put. And now let's use some very obvious mathematical operators. We have a max function and a minimize functions. There's one element over here and there's another element over here. And what this max function do is it gives the output is the larger of the two. So what it means here is that when we have a long call, the payoff is either zero, the larger of the one, the zero, or ST minus K. Let's look at the notations carefully. What does ST over here mean? ST, it's price at time to maturity. And this K is this predetermined strike price. So it's either S0, okay, just like what we see over here. If ST turns out to be larger than K, say $107, and K over here is $100, then this long call will give us a payoff of say $7. If it turns out that the ST is smaller than K, so it's 90, 80, 70, then the long call's payoff is basically just essentially just zero. Long puts, like I said, it's like a mirror image in the horizontal axis, in the horizontal sense, that it's a max function of K minus ST and zero. Why was that the case? Because we're now we have the right to sell something to people. If it turns out that the strike price is higher than underlying, then it's very optimal for us to sell it right, to exercise it and sell it. If you are going to sell it at $70 and the current price was just $50, then you basically earn exactly $20. If it turns out that the stock turns out to be like of a price of $110 and the strike price was $70, it's not optimal to sell it through exercising these options. You would rather just not exercise this option and then sell it otherwise you are at the spot market. When we look at the short position of long and calls, then basically it's just changing the sign of these payoffs. Now the long position has the payoff of max ST minus K and zero. The short call has a payoff of negative max ST minus K and zero. And if you just short put has a payoff of a mean function of ST minus K and zero. It's the smaller of the two. So basically, if it's a negative number, then this is still payoff. Your payoff will be a negative figure. If this turns out to be positive, then you're just having a zero payoff. Once again, payoff is what we see over here. That's what, regardless of the costs, it's what you can expect for at the end of the maturity. Okay. So these are the four very useful payoff functions you're going to see a lot in the following few chapters. Okay, almost there. Yeah, once again, the payoffs of options, you can see that the payoffs, how do we go from payoffs to P&L? This is profit and loss. P&L, we're basically just shifting them vertically according to the cost or the premiums you get to construct these positions. Now let's talk about specification of a stock options, expiration date, strike price. Yeah, so for when we are there to talk about an options, we need to think about these are the things that you should be focusing on. It's first either it's a European call, European put, or American call, American puts, European American call or put, and then we have to care about again what is the strike price. The strike price is that case over there. Expiration date. Expiration date tells us information about the time to maturity. These are important features you need to think about. And then moneyness. Yeah, moneyness is also something you have to understand. It's there's actually three types of moneyness. People, when we are talking about stock options or any kind of options, we usually call an option in the money option, at the money option, or out of options. What it means is that if it's in the money option, it basically means the underlying asset has a price similar to the strike price. If it's an at the money option, it means that if you can right away immediately exercise this option, it will be rewarding. Say for a call option, it basically means that the strike price is lower than opposite to the at the money options. This is what we call the moneyness. Option class, again, it's a put or a call. And intrinsic value and time value is also very important concepts to learn about. When later on in I think chapter 12, we're going to learn about what is the determinant of an option prices. And you're going to see a diagram that looks like this. This will be the value of this will be a value of the European call option along the underlying assets. Say this is, and then you can take a look at there's a difference between the value and also the payoffs. What does it mean? It basically means that these intervals between the payoffs and also the real values is what we call a time value. Why was there something called a time value? It's basically because when you are holding these options, the time to maturity itself comes with some value. The fact that there's still some time before it matures provides the stock prices some rooms to fluctuate. There's chances that you are going to go to a scenario where you're going to experience a very large gains, even though it's symmetric, that symmetrically you may also experience a scenario where the stock can go really bad. But think about the call option itself, you know that your downside risk is truncated. So when you are holding an option, you're actually very willing to see a fluctuation or volatilities in the stock price or stock returns. This distance between the true value of a stock and also the underlying and also the payoff is called time value. And intrinsic value in this specific sense is it's just similar to the payoff itself. It's what you can get as if there's no time to maturity or as if you are going to exercise this option right away. So many people will first break down option value into this two components. It's a combination, it's a summation of intrinsic value, the value that you can enjoy as if you can exercise it right away, and also the value of the time value, the value that provides some rooms for you to experience an even larger potential gains in the future. That's some terminologies that people have to first consider about. We are almost there. Yeah, two more important concepts and we can finish this chapter. So in this chapter, we will not discuss anything about pricing. We will not talk about what are the determinants, what are the possible strategies you can use to construct using options. We're basically telling you some important features about the option, the contract themselves. So first, one thing we have to care about is if we are talking about stock options, what do we have to do when there are stock dividends or stock splits? And the answer is very straightforward. You just equally increase or decrease the number of shares or the number of the price of the stocks that you are considering. What do I mean? Basically, let's suppose that we are doing an N4M stock split. What does N4M stock split mean? Say if there's a 2-for-1 stock split, it basically means that in this kind of stock splits, one share stock that comes with $100 become 2 shares of stock, each comes with $50. So there can be all kinds of N's and M's. These are just events. If it turns out that there's an N4M stock split and the previous strike price was K, then the new strike price will be M over N multiplied by K. And the number of options that you are going to buy or sell in that something you promise in the contract will go to n over m multiplied by this capital N, which is the previous number of shares that you are going to buy or sell in the original options. This is N for M stock split, and stock dividends are almost exactly do exactly in the same way. If there is a stock dividends, that makes your previously when you have one stock, it becomes two stocks afterwards. It's just exactly the same as a 2-for-1 stock split. The effect in terms of your option contracts. Let's go through some examples and you'll have a clear idea. Consider there was a call option to buy 100 shares of a company for $30 per share, the company stock. Suppose the company makes a 2-for-1 stock split. The term of the option contract are then changed so that it gives the holder the right to purchase 200 shares for $15 for each share. That's basically what we do for a 2-for-1 stock split when you are there to consider about the call options. Now let's talk about stock dividends. Consider a put option to sell 100 shares of a company for $15 per share. Suppose that the company declares a 25% stock dividends. What does a 25% stock dividend mean? It means that previously when you hold like 100 shares of stocks, then after this stock dividends, you'll be holding 125 shares of this company's stocks. So this is equivalent to a 5-for-4 stock split. So it turns out that afterwards, you have the right to sell 125 shares for $12. 125 shares because we now go from 100 shares to 125 shares. And for each share, it goes down from $15 to $12. Does that make sense? Okay. Now, market makers, nothing specific. Let's talk about margins. Yeah, margins is the last boring part of the whole course. Afterwards, we can forget about all these rules. So now, once again, in the previous courses, we talk about what to care about when we are to buy or sell, or when we are to trade futures, right? This is also the case for options. You also have to care about margins. And usually when you are standing at a position where you buy, when you long a call, you don't have to worry too much about it because you don't have unlimited downside risks. If you're buying using your own money, then there's nothing to worry about margins. You only have to worry about margins for two cases. First, if you are like borrowing to buy, usually the traders, the broker firms in the US allow their investors to buy on margins. What do I mean by buy on margin? It basically means that you can borrow some money from the broker to buy something that's more than what you have. Usually when you buy stocks in the US, people can buy on margin for up to 50%. It means that even if you only have like $100, you can buy the stock equivalent to the price of $150. Like you're borrowing $50 from the broker to buy something more than you have. For options, this is more restricted. You can only borrow up to 25% to buy calls or puts that has a maturity longer than 9 months. That is the first case. If you are buying on margins, then you have to consider about the margin, the balance in your margins. In the second scenario, if you are shorting, like I mentioned earlier, if you're shorting either a call or a put, it's similarly as if you're underwriting it, and then you have unlimited downside risk. In that case, the broker firms and also the exchange will ask you to post more margins. For example, when you are written some naked position, what we mean by naked position at the same time, you're just writing a call or writing a put without doing any other things. Suppose that you are writing a naked options, the margin will be the greater of the two. It's either 100% of the price plus 20% of the underlying share price less any amount that is out of money, or it's just 10%, 100% of the price. What do I mean? You'll have a better idea when we proceed, when I show you guys an example. For example, an investor writes 4 naked call option contracts on a stock. The option price is $5, the strike price is $40, and the stock price is $38. So like I said, it's a call option, and now the stock price is $38, the strike price is $40. So at present, this call option is out of money, and out of money for $2. So then the calculation will be the margin that the broker and also the exchange requires you will be either the greater of the two. It's either 5, that's $5, that is what I mean by a total of 100% of the proceeds, plus 20% of the underlyings. The underlying is the stock, and the stock has a price of $38, minus $2, which is the amount that this option is out of money, or the total of 100% of the proceed plus 10% of the underlying. So it's $5 plus 0.1 multiplied by $38. So you have to calculate both of the two and then decide which one is larger, and the larger will be your margin required. So there's two types of ways to do the calculation. The reason why is because it could be the case that it's super out of money. Then in that sense, this calculation may be asking for too few of a margin. So that's the reason why it has to be 20% multiplied by the underlying price minus the amount how much this option is out of money, or just 10% of the underlying assets price. So you calculate the two and look at and check which one is larger. The larger one will be the margins required when you are underwriting this naked options. And now we are writing 4 naked call option contracts. And conventionally, this is not, I didn't put this in the slides because I don't think that's a very important piece of knowledge, but usually conventionally, one stock option contracts is on 100 shares. So 4 naked call option contracts is on 400 shares. So 400 multiplied by this calculation, 400 multiplied by this calculation, you get 2 figures, and the larger one is $4,240. The initial margin required will be $4,240. Okay, so it's basically the larger of the two. It's also the case when we are talking about put options. Suppose that now we have exactly the same sets of numbers, but now suppose it's a put option. Then what is the calculation? This calculation will be exactly the same, but then for the first calculation, since it's a put option, it's no longer out of money, so it's just 400 multiplied by 5 plus 0.2 multiplied by 38. There's nothing to deduct because when we are talking about the put option, it is actually at the money right now. And this will come with an even larger number. So for put options, it will be the larger of the two. It will be either this number or this number, and it turns out that this number is larger, so this will be your initial margin requirement. If you are underwriting a put option of exactly this, if it happens to be $5 and the strike price is $40 and the stock price is also $38. Yes? Do you remember when we are talking about the futures, we have to post margins? There's daily settlement. What is daily settlement about? Daily settlement is when you experience a gain, your balance will increase. When you have a loss, your balance will decrease. And then when your balance decreases to some very low level, the broker will ask you to post more margins. And here what we're talking about is we are talking about what is the margin required for you to trade options. You have to save it in the balance account in your broker account, so that only by doing so, the broker and the exchange will allow you to underwrite of naked call put options. And why is it only required for underwriting naked options? Underwriting naked options is equivalent to standing at a short position, a short call or short puts, right? Why was that the case? Again, that's because if you're underwriting a short call or short put, let's look at this graph. If you're underwriting if you are shorting the call or shorting the put, the downside potential is unlimited. It can lose a lot of money. You can lose a lot of money. So that's the reason why they will ask you to 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 top up your balance account, which is the initial required margins. When you are like conducting this kind of trades, when you are longing a call or longing a put using your own money, then there's nothing to worry about. The broker won't be afraid about you being defaulted, you going default, because there's nothing for you to lose. You already paid it and just non-negative. But if you are underwriting a call option or underwriting a put option, then they will ask you to post some money, and that's the money amount that that's the calculation, the rule for calculating how much margin they will ask you to post. It's the larger of the two, either 100% of the price of the option themselves plus 20% of the underlying assets price, or 10%, and then minus the amount that is out of money, or just 100% of the proceed of the option themselves plus 10% of the underlying assets.
That's the definition, right?
This is definition. Yeah. Not the case. This is the margin for naked options, and when you are there to borrow to buy, it's called buyout margins, and you can only borrow up to 25% to buy. And like I said, when I say you're standing at a long position, you don't have to worry about any kind of downside risk, and the brokers and also the exchange won't be afraid that you will default. It's because your payoff diagram is not negative. Shorting, you're underwriting the naked options, you will be asked to conduct those kind of calculations and decide how much margin you have to post. Sense? Cool. Any other questions? Yes. It's not allowed to buy on margin. It's not allowed to borrow money to buy. You can still buy. It's because when there's, like I mentioned over here, when the time to maturity is longer, there's more room of the time. So it's more likely that you're buying something that's worthy. But then if the maturity is shorter, the broker will be more and more afraid that if it keeps staying out of money, then this is something that's worthless. And if you are borrowing money from the broker to buy something that's worthless, then the broker will be a bit like nervous about these kind of scenarios. So it's only allowed to buy a margin for options that has longer maturities. The logic is like that's the intuition. Are you asking about this intuition?
Options with maturity less than 1 month has higher leverage. I don't know why. Do they have higher leverage?
Higher leverage in the sense that they have lower net worth, and then it's basically like you are having a higher leverage ratio. You are borrowing to buy something that has a lower net worth, and it's like you are making your leverage ratio higher. Leverage ratio in terms of debt over net worth. Sense? Yeah. Everyone okay with this part? It's not, yeah, this is a bit boring. It's just some conventional rules in the US, but yeah, that's the case for everywhere in the world, but we might have slightly different rules. So lastly, let's talk about some other type of options. When we talk about stock option, it's basically the option that you can buy or sell stocks. And there are also other types of options that's very similar to stock options. The first type is the warrants. Warrants is almost like exactly like stock options, but it differs in two senses. In the first sense is that it's underwritten by the company of the stock themselves. And in addition, when you are say you are the holder of this warrant and you are exercising this warrant, it basically creates new shares of this companies. So that's only the two very big difference of warrants from a typical stock index, a typical stock options. Oh yeah, I forgot to mention something. So yeah, the last thing about underwriting a naked options and the margin required is that if it's actually an option on a stock index instead of an individual stock, the 20% is replaced by 15%. Yeah, that's something worth mentioning. Okay, and warrants, employee stock options. Employee stock option is also very popular in the US. You can see that working at tech firms, usually your salary package comes with a big chunk of components of employee stock options. There are also like stock options, but it also has slightly different features. Again, it's like a warrant that if you exercise it, it creates new shares of stock equities. And in addition, most of them are designed in a very adamant sense. It means that they're trying to create an incentive for the employees to work hard and drive up their stock price, even though, and it's like a free benefits for them to do so. But then if you work harder and make the net worth of the company even higher, it's even more appealing for you to exercise. And usually you cannot exercise it right away. Usually it comes like you can exercise it if you're standing at the point of an employee. Usually you will be able to exercise your employee stock options like in 2 years or in 3 years. That's usually the case. So that's employee stock options and warrants. Convertible bonds. Convertible bond is also very similar to stock options in this, but it also deals with the capital structure of a company, because what convertible bond is that the company issue these kind of bonds, and the hope, and it usually they will come with some kind of conversion ratios. And whenever the holder of this bond find it optimal to do so, he or she can transform this bond into a stock, basically making him a liability owner, a debt owner to an equity owner. So you can see that for some companies, they try to use convertible bonds to rebalance their capital structures. At the same time, these convertible bonds are also mostly callable. They are mostly callable bonds, so that companies can also call them back whenever they find it optimal to do so. That's also another reason why many people believe that convertible bonds are designed for companies to rebalance their capital structure. If you are familiar with your financial management courses, you know that there's the theory, there's the optimal capital structure theory. Companies usually try to do these kind of manipulations to optimize their own firm values. That's pretty much about it. So at the end of it, let's try 2 practice questions. These practice questions are also like chapter end questions. There's nothing much in this chapter to test you guys. So yeah, these are probably the only 2 types of questions I can test you guys. Let's consider an exchange-traded call option contract to buy 500 shares with a strike price of $40 and a maturity in 4 months. Explain how the terms of this option contract change when there is the following scenarios. A, when there's a 10% stock dividends. When there's a stock dividends and it's a 10% stock dividends, now your contract goes from buying 500 shares to buying 550 shares. The price goes from $40 down to like only 10/11 of the price, which is 36.36. B, when there is a 10% cash dividends, remember that when there's a cash dividend, it does not affect the terms of the option contract at all. Because yeah, the company is basically just paying the direct cash to their stock owners. C, a 4-for-1 stock split. It means that once share become 4 shares nowadays. So previously your term was to buy 500 shares, now becomes to buy 2,000 shares. The price of the strike price goes from $40 to $10, 1/4 of the original price. That's it. The second question is to ask you calculations about underwriting naked options and the margins about it. A trader writes 5 naked put option contracts, with each contract being on 100 shares. Means that he's trying to sell, he has a put position, he's selling a put positions to buy 500 shares of the stocks. the option price is $10, the time to maturity is 6 months, and the strike price is $64. What is the margin requirement if the stock price is $58? Then we have to calculate both of the two calculations. If it's $58 and the strike price was $64, then basically this put option is at the money. You're going to sell something at a higher price than its real spot price, so it's at the money. So we don't have any part to deduct from the out of money amounts. So it's just $10. The option price itself plus 0.2 multiplied by 58, which is the underlying price. Or let's take a look at the rule once again. It's either 10%, 20% of the underlying price, or for the put, and also 10% of the exercise price when we are looking at the put. So it's 20% of the stock price or 10% of the strike price. It's the first calculation gives us a value of $10,800. The second calculation gives us $8,200. We're picking the one that's higher. So in the first scenario, when the stock price is $58, the initial margin requirement will be $10,800. In B, how would the answer to A change if the rules for index options apply? Say now we are not talking about a put option for an individual stock. We're talking about a put option, say for the S&P 500 index. Then we just replace this 20% with 15%. It will give us $9,350. That will still be the larger one. C, how would the answer to A change if the stock price were $70? If it's $70, then now it's out of money. So it's out of money for $6 per share. So then we do the calculation. The first calculation will give us $9,000, still larger than $8,200. So in scenario C, the initial margin requirement will be $9,000. D, how would the answer to A change if the trader is buying instead of selling the options? Like we mentioned, if they are buying, then there's nothing to be afraid for the broker. So we don't have to. So there's no margin required if the trader is buying. That's it for chapter 10. It's a very short and like an introductory chapter. The very important point is to, of course, understand the difference of these warrants, employee stock options, and also the terminologies. But I think the most important thing is to get familiar with these kind of calculations. We'll use these functions a lot in the afterwards chapters. What is the max function? What is the mean function? Why does the payoff of a long call, long put, short call, short put looks like these? You can try to practice yourself, try to draw these diagrams, and once you get familiar with them, you will have a better preparation for the future chapters. That's pretty much about today. Okay, so see you guys next week.